Other type of risk what you have is credit risk. Credit risk is when the issuer will not pay the money. Liquidity risk. Liquidity risk is when you have the bonds and you are not able to sell that bond in the market, so you have to sell at some arbit price. You will not be able to realize the entire price but that you had earlier thought. Okay, what is inflation risk? Inflation risk is the risk that inflation is more than the expected. When the inflation is more than the expected, you would not be able to earn a higher return, so higher real return, so your real return decreases because of the inflation. Okay, volatility, here we are talking about the volatility in the interest rate. So if the interest rate is volatile, what happens is the bonds, okay, the bonds are impacted. Please note that the volatility risk does not impact the straight bond. Okay, that is bonds without embedded put or embedded call are not impacted by the volatility risk. Okay, then you have event risk. Event risk are like when there is extreme event happening. So let's say you have an extreme like event happening which happened in nuclear plant in Japan. Okay, so the firm which was owning that nuclear plant, okay, obviously here the government was owning, but let's say if there is a nuclear power company, the firm which was owning, so they would have suffered a lot of losses, so their bonds would decrease. So event risk is there. Sovereign risk is when the government defaults. So when you have invested in a government bond but the government defaults, that is a sovereign risk. Okay, exchange rate risk, you will suffer from exchange rate risk only when you have invested in foreign currency bond. Okay, so let's say if you are an Indian investor, if you are invested in INR bond, there is no foreign currency risk or there is no exchange risk. Okay, but if you have invested in USD bond, because of the fluctuation in the bond, because of the fluctuation, there will be loss or gain. So think about, let's say the dollar is today 50, okay, and you have to get a $1 coupon. So if it gets converted, you are getting a Indian rupee 50 coupon. So 50 rupees is the coupon that you are getting. But think about if the dollar becomes weaker, from 50 if it becomes 40, the $1 will become 40 rupees. So in your earning in the domestic is currency is lower. So as an investor, we are concerned about how much money you are earning as domestic investor.